Well, look, I think the market is having difficulty differentiating between, what is true lasting inflation and what is a price level adjustment. And so when you actually go beneath the headline, well, you're going to see that most of the inflation was in, a few areas like used cars. Well, that's a semiconductor shortage development. But you also had like 10% increases or thereabouts in hotels and accommodation and in sporting events and things of that nature. What you'd be expecting with the economy reopening would be bouncing up a lot. But, what's interesting is that the Cleveland Fed actually publishes a median CPI, and this shows you the distortion. Headline is up 0.8, but the median was up only 0.2. So it was a very skewed report, in my opinion.
So it sounds like you're in the Fed camp where you think this is transitory or not going to be as worrisome of a problem. David, what would change your mind? How many months of these types of numbers and what sort of components should we be looking for that would potentially be more worrisome?
Well, look, I think it's always important in any piece of economic data or market data to look at dispersion, which is why, you have technical analysts on looking at the breadth in the stock market. The breadth in this market wasn't pointing to inflation, but, when you have a few sectors that are up 10% in 1 month, and keep in mind that, areas like airline fares and the CPI are still down almost 20% from where they were before the pandemic. So the point I'm making is that, look, if we get another number like this, next month, the Fed is clearly going to have to start changing its tone, and I'll be compelled to change my forecast. But, it's funny, everybody's talking about the non-farm payroll number as an aberration and a 1 month figure that we should just ignore, but they don't say the same thing about the CPI. Look, we know the Fed's already prepped us for inflation because of the distortions that they're going to come in high in the next few months. But I would say, Sarah, we get another 1 or 2 months like this, and the Fed's going to be in a box. There's no question about it, but it's not my expectation.
So you've been very bullish on bonds, David, and they're not looking too safe right now. Big sell-off, 10-year yield just hovering around that 170 level. On board with this whole inflation story, where do you go? Where do you tell investors to go in this kind of environment? Well,
look, in near term, you could see more upside pressure bond yields. I mean, the reality is that we're still not at the peak we were just say over a month ago. But bonds aren't behaving well, and growth stocks aren't behaving well. And I think that the markets have inflation on the brain. I would say, despite view, and I have a view, look, there's uncertainty around everybody's view. But my sense is this: the stimulus is going to wear off in the second half of the year. The jobless benefits, I think, are going to term out in September. And I believe that the supply, which has been held back, is going to come back with the lag as the economy reopens. To me, it's disingenuous to believe we reopen the economy. Oh, it only has an impact on the demand side, but not the supply side. So, this time last year, we had CPI nosediving. Did we get the actual outright sustained deflation? The answer is no. And I think we've swung the pendulum the other way. And I think that this inflation situation, which we have in our hands, I think, look, I'm not embarrassed to say that I do agree with the Fed on this one, but I think that by the end of the year, supply and demand is going to come into better balance, and we're going to have these inflationary pressures start to subside. So I'm one of the few people saying, if you're going to dips, I'd be buying the dips in prices at the long end of the Treasury curve. I don't think that the inflation situation is going to be sustainable beyond a couple of months any more than the deflation was this time last year.
Shepard Smith here. Thanks for watching CNBC on YouTube.